Alright, everybody. Let's start talking about trading, and I'm going to take you through my methodology from top to bottom and sort of the whys, right? So first of all, fundamental analysis. Why don't we just go on Simply Wall Street and look up the best stocks in terms of fundamental analysis and invest that way? Because, if we could do it on Excel sheets, but we can also use tools to understand the delta between this kind of discounted cash flows, fair value, and current price. And that should be that's a value investment style. That's Warren Buffett. That's how it goes, right? Well, that kind of drives off this thesis that the market is inherently rational. We're surrounded by rational actors. And it's up for every person to decide whether you think that market forces are driven by this type of supply and demand, very mathematically concise market factors, or if they're driven by market psychology and speculation and emotion. And even within institutions can front run moves, they can be behind on moves, they can trade on news, they can be based on fear, they can do things based on rates. In the short term, if you look at all the correlations, you look at all the valuation data, there's very little correlation between these types of metrics like PE and market and price behavior. It's more of a it's more of a macro driver of the market. And everything now is correlated. I mean, things are 99% correlated. It's interest rates, it's inflationary forces. I think those ultimately govern the market way more than valuations. I don't really even think valuations are that useful. Now, what are value? I mean, I've had seasons where I try to just buy the most fair value stocks. The ones that were down here where they're 1% of the discounted cash flow price. And what you end up finding is you just get into these value trap stocks. Like you'll buy some micro cap miner in the United States that's just a slug. It doesn't move. It just keeps going down and down and down. You just get stuck in a lot of value traps doing that type of method. Now, what do we use valuations for? What are valuations useful for? I think valuations are good for understanding a type of risk when it comes to the company. So say, for example, price earnings ratio. This indicator lets you know how much crap am I going to have to deal with owning the stock that's just unpredictable, unforeseen variables that are going to mess with the price action and make it difficult to hold. And the bedmate of that is in debt. If we look at actually financial health of the company in debt, because if we see something like this where long-term, short-term liabilities are near assets, it basically forces the stock that we own to dilute and to print more shares or to seek financing in different to maybe your favorite part of the company they're going to divest. It just creates a lot of nonsense that inevitably results in you as a shareholder getting basically killed, getting shafted. Because if you look at your balance sheet of assets, liabilities, shareholder stocks, that's the first thing to go. As a shareholder, is the first one to go. So you're going to be that guy. So when I'm looking at a stock that I'm going to hold for a long time, I'm going to look at, is the PE positive? That's really the only metric. Generally, the stocks that I look at, the price to book is pretty low, like hovering around 1. And I just want to make sure there's no nonsense in terms of financial health. Some industries are different. In terms of long-term, capitalized assets for mining equipment, that's very different than anything else. It's industry specific, but especially short-term liabilities, we don't want to see that super high, because that just means at first notice, they're going to be sending a letter to you as a shareholder in the mail from Fidelity, and you're going to have to vote on whether or not they nuke the company. Finally, dividend. I think dividend is really great. Dividend is one of those things where if you're holding traditional assets, you have them in a Roth IRA, you have them in healthcare savings account. The joy of the dividend is that it de-risks holding an asset over a longer period of time. So it's really hard to nail the macro in terms of tops and bottoms of the stock when it hits that top price range, when it hits that bottom. But you have a security blanket when you have a dividend where you are compounding. And especially if you don't nail the lows, you catch a falling dagger, catch a falling knife, you're in that accumulation stage for a long time. What kills you with your trading strategy is that is actually time decay. So you could have let's say for example you double your money, but you doubled your money over 10 years. Well, the S&P doubles the money every 7 years. You're underperforming the S&P. There's no point for you to invest and to speculate in individual stocks. So time is actually one of the biggest components. Dividend helps you with time. And when you're accumulating at those lows and you have, like, you're in an oil stock where maybe you have 15% dividends, and you're accumulating at those lows, it makes your inevitable reward of reaching those price highs even better. And there is a philosophical conversation on dividends themselves. Do dividends kind of point to a company that it's not profitable to invest in its own operations, so therefore they pay the shareholder a coupon rate? In some ways, I think that's kind of true. So ultimately, this is like it's a correlational play, but certainly there are instances where this is a good idea to sit there and collect that dividend. So say, for example, like for Petrobras, you look at the dividend, it's 15%. You're already beating the S&P, which averages out 10%. Maybe this fits in your portfolio as a non-correlated asset. It's kind of mid to large cap company, emerging markets. It diversifies you in a lot of ways. There are moments for it. Here's another one. Copper, Amerigo used to have a fat dividend, copper stock. So these are really great plays when you don't really know what the market direction is going to be. You can't get screwed too much if you're holding. This used to be 10%. It used to be a fat dividend for copper. Hey, if you don't know if it's going to go upside or downside, if it's one of those scary market environments where we're going sideways, hey, buy a dividend stock. Where dividend stocks are not cool is if you're going to buy an option. If you're going to buy an option, you're missing out on all the dividends. So, I'm finding that in the scope of time, if I wait 10 years, I get a double. Is the juice really worth the squeeze? And that's kind of my methodology in stock picking too. And this is where we can start going into trading view. Is the truth? Time is so important to consider. So Petrobras, if you look at the stock, the market cycle is like 8. It's like 16 years. So I think that's something important to consider. You feel safe in these mega cap, large cap stocks, but do you have 18 years to wait to get a double? This one you can probably do it because you have a dividend that's hedging that theta risk. It's giving you that guaranteed 15% return. But it's something to think about. Time is everything. It used to, in the old days, you would feel psycho for buying a 2-year option leap and levering up on the potential gains. But now, you got to make money when you're right. And really, the risk of loss is not, if you're picking the right stocks, the risk of losing is much less than the risk of not winning or not winning enough. Because let's say, for example, you wait, 6 years for this setup and you didn't make any money on it. Who cares? Buy the index. Okay, let's look at how we look at these stocks when it comes to charting. This is like so one of the things, charting seems kind of spooky. It seems like reading the tea leaves. It seems like, oh, okay, charting, you're just drawing lines on a graph. What does that mean? Well, one of the things is BlackRock gets the news before you. They're front running the major moves in the news. So the price behavior tells you a lot about the psychology actually of the institutions, and then inevitably of retail, who tends to buy the highs. So it's not just reading the tea leaves, because it's showing you the price action, the volume, the order flow of these institutions, Citadel, BlackRock, these guys. Another thing with the chart is it shows you volatility. So say, for example, in the chart, We have natural periods of volatility expansion and volatility compression. And there's sort of this is all gambling. If we gamble at it and we say, okay, I have this moment of volatility compression where I'm going from these wild moves and we're squeezing and we're squeezing. Well, at this point, volatility cannot go to zero. Volatility is expansive and retractive. So if volatility is going to go up from here, that means we're going to have a disproportionately outsized move. We have an opportunity to place a stop loss here and say, are we going to spring into that expansive volatility in the direction that I'm proposing? So that's why the chart is not stupid. And in looking at the chart is not stupid, it's not illogical. Let's take a look at some of our chart patterns. I mean, some of the classic chart patterns are like basically what I do when I'm looking at these stocks. I'm looking at macro turning points for stocks. So if I take a look here, and then you always use logarithmic on the long time frames too. It gives you more of a normalized chart, because otherwise the scale is going to mess with what you can see. So let's take a look here. This is an easy one with gold. Here we go. So basically what I look for is I'm looking at these volatility squeeze wedging structures. So say for example here I'm seeing this triangle, and it's telling me, okay, we have a volatility squeeze where they're going to shoot to the upside or the downside. And I know there's these shapes come in different forms. So this is a bull pull, a bear wedge on a bull pull. Now another structure you might see is a bull wedge on a bull pull. This tends to be a reversal structure. So this tends to indicate that things are gonna go the opposite direction. We also have the head and shoulders pattern like this, and then we have the inverse head and shoulders pattern like this. What I'm seeing in the market a lot nowadays too is this structure, the Adam and Eve, the pointy into the round, and vice versa. Those are kind of common structures in the market that are probabilistic outcomes. That's on the small time frame. Really, the big moves are going to be these big macro wedges. So say for example here, because I'm zoomed out in terms of time frame, it doesn't seem like a long time. This is an 11. This is a 5-year setup. Okay. Now let's take a look at, and generally these things tap the upper trend line like 3 or 4 times, 3 to 4, generally 4, and we can make price predictions based on the depth of the actual pattern itself. So so boom, I had my falling wedge structure, but this is actually, it became a cup and handle. Okay, but let's say, I didn't know it was a cup and handle down here. So how would I try to guess at what the next price action is going to be? Well, if it's a cup and handle, let's zoom back to that. It's just doubling the cup and handle. It's kind of a price target. So let's see if we've even hit that. We're probably pretty close. Yeah, so we can make maybe a price estimate that we're going to reach this level with gold, 3,500, nice round number. That wouldn't shock me. But let's say that we're zooming back in a time and we're at this moment. Well, you want to buy deep into that wedge. If you want to put a stop loss, you can put one down. I wouldn't hump the chart, because you're just going to trigger it on a sort of market volatility order flow. It's going to trigger, stop you out. Algos are going to kill you. So so you put it down where 10%, way below where your logical mental level is. It's got to be low. That can make you feel safe. Sometimes stops kill you though. Tight stops kill you because it whipsaws down and then you miss the move. That happens a lot. But one of the ways we can predict price is using Fibonacci. And I don't know, Fibonacci is one of those voodoo things. Like, it just tends to work. I mean, it just tends to be a price level of significance. Generally, when you have a type of retracement, so if I have a retracement move, I'll tend to pull back from this level 2 to 3, generally 3 on a kind of a bullish continuation. And then, if we have a nice bull cycle, we want to hit this level. And we want to hit this level as a kind of a speculative high point. What I think methodology-wise is better, instead of just hitting that tripwire at 2400 and selling, is setting a stop loss at this level once it overshots. So you allow yourself to reach these higher levels, but you don't get killed. You've locked in this profit with your stop loss. I think that's a better methodology than just doing a market sell. Something I'm starting to... yeah, so that's how I would set a price target for a potential move. But looking at RSI as an indicator, this is something that I wouldn't put too much stock in, but it's kind of interesting. Is the RSI can kind of tell you tops. It can help you cast tops and bottoms. So generally, this isn't perfect, but as it escapes this, as price escapes this bottomed out lower quadrant, you are kind of emerging into the next momentum, bullish momentum. Likewise, it's not necessarily when it peaks, it's actually when it starts going, like you don't want to, it's less on the break. That's kind of the best time to hold the stock. It's more on the peak and the retracement, especially back into this lower quadrant. You may be experiencing the like a logical place to sell, but don't put too much stock in that. I'm not super time tested Mr. RSI because it's a trailing indicator, so don't kill yourself with the RSI. Don't become Mr. RSI. Look at it less than you think you should, because that is a good point. With trailing indicators. Price is not a trailing indicator. Fibonacci is not a trailing indicator. This is a trailing indicator. So it should be taken with a grain of salt. Okay. What else? Let's maybe walk through a trade. Recent trade. Or even vehicle selection. Vehicle selection is so important. Like gold. What's the gain here? If I nailed it, I played it perfectly. Nailed this 1,000. Now I have 3,000 in 10 years. So that means I'm getting 300% return over 10 years. 30. That's really freaking good just for normal gold. So if you nailed, you could just hold that if that's a profit that you're okay with, or you can buy a 2-year leaps option at this wedge break, or you can go to something like a Caliber Mining. Let's look over the same duration, 2016 until now. How much money did you make? Insane. Look at this. If you sat in this. Oh, this is a bad listing. $2015 to now, insurmountable. You're making just like insane amounts of money. So that's one way to play it too. This is a mid-cap mining stock in Brazil. Here's the pattern. Boom, head and shoulders. You buy this, neckline break 1.76. You doubled your money, pretty much. Let's look at, so that's vehicle selection. Let's take a look at something like JD. I think there's a lot of good plays just in the traditional markets right now. Let's take a look at JD. I'm just taking a look at this one, and I'm taking a look at my Fibonacci's, and I'm noticing that, hey, we're hitting one or two fibs above on a market peak. So let's run that experiment again for this current cycle, and 251 is a possible price target. Now I like to have my vehicle selection in these tight little windows where I want either a 10 bagger on this lower bracket, or I want a 10 bagger on this higher bracket, and then I'm going to buy a 2-year option. I think is a good strategy. Crypto is really juicy right now because the time to the cycle highs is shorter. It says the frequency is shorter. It's better on time. You're not taking as much loss. What is this crap? Is this like inverted? No, it's not inverted. Let me remove drawings. Missing some price history on that one. Kraken. Okay, here we go. Here's one. You know, let's look at cycle. General cycle is 2 years. So that's 2 years. Sure beats a lot of these other investments where you have to wait 10 years, and the volatility is plenty. The price target. So let's check out these price targets. You know, we're taking a look at fib levels. This is probably a crypto version of an IPO when the token is just dropping and initial investors hold it. So these are not, looking at these early price behaviors of crypto is not great, but hey, we nailed almost this level. We're in this range. And if we bought the bottom, we're at 0.18, and we've made like this insurmountable amount of money at these lows. Let's use our logarithm. Oh, we are using logarithmic. Let's look at regular. So yep, that's vehicle selection. If you look at this as one cycle, $10 here. So I want to buy under $1. Would be really nice. So yeah, and then I think you know, these seem like really sexy trades. Like, oh man, I'm gonna buy this deeply undervalued crypto asset and try to hit this fib level. But man, you know, there's a lot of traditional stocks where maybe it's a 5-bagger, and you take an option out and it becomes a 10-bagger. You take a 2-year leaps out, it becomes a 10-bagger. And when do we buy those leaps? This is like a strategy thing. Let's look at JD again. When do you buy those leaps? Options contracts, and you just keep rolling to the next best investment and the next best investment. You buy let's go here. You buy on the trend break. So you can buy them when this guy starts squaring up down here, or you can even buy the retest. You just every dollar you have, you just slam down into options. Can you imagine? You buy these lows somewhere in this trench, and you're getting 40%, which this is a trade that I did make. I bought down here during this time. 40, 60, 57. You buy a 2-year leaps, you probably have 120% profit, and then you can just sell half of them and you're in a free ride position. You buy this one, how high would you be? From, well, you wouldn't know that level. You'd probably buy this retest. You know, let's say 35.92. It's quite a bit. Anyways, this is quite a bit of gains if you buy a leaps option. And shoot, you just wait and you hold it all the way back up. You're in the secular trend. Look at the concavity, or the concavity that's forming. Bowling out. Oh yeah. Just wait for this level and you hold. And that's where I get myself killed, is I don't hold it long enough. But the prediction method is pretty reliable. Copper Mountain. Is this even trading anymore? Or did it get taken off? Gold Mountain. Anyways, cool. So I think that's a good method. I mean, what else do you need? And you can just stock these stocks like what's it? Lending Club. Consumer lending. Let's say you're predicting, okay, on the macro level, shoot, let's be honest, consumer purchasing power and ability to take out finances is probably at an all-time low, because of inflation relative to wages just being insanely low. Well, let's take a look at these trend lines. And maybe you can be the guy who buys it down here, throws down a 2-year leaps option, or maybe you buy it here, or you buy the retest, and you are making potentially almost 18, 19, 20 times your money up here. If you bought an option, 15 times your money here. And you just hold it and you roll them. And you wait for that volatility compression. Here's an example of that coming to pass on XRP. This is a classic. Now it's all screwed up because the price went up so much. But if you look at, it's because it's Coinbase. Doesn't have good price history on XRP. Here we go. If you look at XRP, you just watch this wedge. You just are you sports fan. You're watching the LA Lakers for 20 years. You can watch this, check in on it, see when it gets down to this compression zone. See when the volatility starts to narrow, kind of DCA in, buy some coins, and then lo and behold, you've reached this all-time high. If you bought down here, are rich. If you bought here, that's a 8-bagger, 10-bagger at the all-time high. And let's say that we form a bull flag here and we hit, boom. What have you made from 50 cents? 10 times your money. Pretty good. Quite a bit of cash. And here are the patterns playing out in real time. So, let me know what you think. What's your strategy? And am I wrong? Is it who's right? George Soros? Market psychology dictates price action. Momentum, speculation, arbitrage, rug pulling, or is it market fundamentals and macro? I mean, you want to see a chart that'll make you not believe in any sort of macro. I mean, look at this thing marching like a soldier upwards. I mean, who cares about the drawdowns? Who cares? I mean, this thing is just a soldier. So there's been a lot of doom callers and naysayers, but how long did these recessions last, even the worst one? 22 to, a year, 6 months. That's what you're afraid of. I mean, this is Ponzi-nomics, boys. This is money printing. This is deficit spending. This is Keynesianism. This is United States being at the center of the world of the currency trade and just being just draining money out of the entire world through this post World War II currency arrangement. Like, don't be short. Get in some longs. Hope you enjoyed. Auf Wiedersehen.